In the last 20 years, value has generally been the wrong bet by quite a margin. Stupid! Do you want to get 1 million with investing? Then you actually need to understand investing. In this video, I'm going to go through 3 screenshots from investor called Sven Karlin and from his video. And these screenshots are actually the comments, and they get a lot of likes always. And I think it's these couple things that is very common for people to think are maybe what 95% of people are thinking. And if you are doing the same, then it's possible that you will never get rich with investing. So this is super important video to understand, and to see. So little preview. Sven Karlin in this video talked about S&P 500 and its valuation and how high the valuation is currently. He talked about the PE ratio, the dividend yield ratio, etc. And he talked about that if these only go back, and he talked about actually the CAPE ratio also. And if these only go back to the historical average, then the S&P 500 might go 50 to 75% down. So now let's go to the screenshots. So yeah, let me read some of the comments before we start. So here, dividend yields and cash flows are two different things and blah blah blah. The reason for low dividend yield is the big position of Magnificent Seven. And then under there is a comment, also increased focus on share buybacks instead of dividends. We are going to go through that very soon. And this is the problem with people. They don't want to think. They are... large shift is because companies are using mostly stock buybacks instead of dividends in the last 30 years. Again, doesn't know what they're talking about. PE expansion has nothing to do with Fed. It's because margins are much higher than they used to be. Yeah, again, dumb comment. There is no reason to think dividend yield will ever return to historical average 5.5%. Yeah, again, dumb comment. And these are all the top comments in this video. It's probably what 90% of the investors think. And this is exactly the problem. Why average investor only makes 2% per year when, you know, And here is the top comment. Your normal yield was only normal up until 1955. You seem to think that dividend yield somehow caused crashes. No, he did not say that. This is clearly the comment is made with AI. So it's, you know, just shows for you it's how you use the AI matters and not, you can get these dumb comments using ChatGPT also. Dividend yields appear to be poor in peak markets. Yeah, exactly. Let's go to that soon. This is funny. In the last 20 years, value has generally been the wrong bet by quite a margin. Stupid comment. Absolutely stupid. Wrong bet. Wrong bet with what reason? Wrong bet if you think investing of how high the stock prices will go. Then it's the wrong bet. But investing is not, you are not here to invest for stock prices. You are here to invest for companies. And it's the exact same thing that people are talking about, that Warren Buffett for some reason he's lost his touch. He's losing for the index. Yeah, he's losing for the price of the index if we look at the Berkshire Hathaway stock. But I don't actually remember, I can put it to the description, but is it over the last 20 years or 15 years? I don't remember. S&P 500 earnings, and remember, over the long term, earnings is all that matters. Earnings is what will give the owner of the company the money. The values will go up and down, but earnings is what you are investing for. Anyways, the S&P 500 earning has gone up something like 3 to 3.5 times. while Berkshire Hathaway earnings has gone up by, and did I say down or up? Anyways, up by 3.5 times. While Berkshire's earning has went up 5 times. Still, the stock of the Berkshire is lagging. Who cares? If you invested 100 euros to S&P 500, I invested for Berkshire. My actual return has went up by 5 times. Your by 3 times. Yeah, you can sell with higher price currently, sure. But that's not what you're investing for. And you cannot make your future decisions by trying to have some magic ball to think, okay, what companies are people valuing higher in the future? No, you are investing for the earnings, and those are what matters. If somehow wants to value Berkshire higher in the future, then you will get the returns also. But earnings is what matters. And we will go through that very soon in the video and go that much more into detail. And sorry, let me calm down a little bit. So let's go to the first comments that talked about dividend yields will never go to up to 5.5% anymore, and that now most of the giving for the owners we are making it with buying back our own shares. And then also a little bit for the valuations, because one of the comments said that the dividend yield doesn't matter because Magnificent Seven and they don't give dividends because they are focusing on the growth. So these are all relating to each other. And first for the dividend yield. Yes, dividend yield currently is lower because they are spending more money for the share buybacks. Currently the share buybacks are about 3.2%, I think, and the dividend yield is what, 1.1%, so that's 4.4%, and the historical average is 5.5. And remember, there is not one single case in the history that we have not returned to the mean at some point. This might be the first, but it would be the first. And there is always these bubbles, AI bubble, stock bubble. Every bubble, people are like, this is the new era. It's never going to be the same anymore. Might be true, might be not. Also remember, AI actually doesn't work necessarily like you think. For example, internet. Yeah, internet make the companies so much better. But where did the money go? To the customers or to the companies? To the customers. Because once everyone got the better technology, everyone has better margins, so every company will lower their prices. Because they're competing with each other. So in the end, almost always the client wins. The prices will go lower and the companies actually doesn't make much out of it. So anyways, so 4.44% is given out currently with dividends and buybacks. But currently also they are spending so much money for rewarding the managers that actually half of the buybacks are just so the stock amount will remain the same. So half of it is for waste. So now we are in the 1.1 plus 1.6, which is 2.7% is actually what is being given to the. So it's still almost 50% down. And also remember that in current levels where the PE ratio is almost 30 and the cash flow yield, I don't know, let's say it's 5%. When you are buying back your shares with yield of 3 to 5%, that is the return you are going to get. And which one is better? Getting 5% return with buybacks or giving it out as dividend and you are able to invest it with 10 to 12%. That's big problem also. And if the companies has better investments than 5% return, that's horrible way of spending your money. And also when it comes to the PE ratio, because the one person said dividend doesn't matter, it's all about free cash flow currently. Yeah, earnings are over the long term, earnings are exactly related on your long-term returns. That's true. Currently, your earnings yield is what, 3.3%. I will put all the correct numbers in the description. And historically, it has been 6.5%. It's new era, yeah, sure. Then again, it would be the first time in the history that things has not returned to the mean. And historically, actually, earnings PE ratio has went many times to this, 7 PE ratio, which would mean that we would go down about, I don't know, 75% from the current levels. It might not happen, yeah, sure. And let's go to the yield. 3% yield currently plus 2% of growth. So that's 5% of returns for you over the next 10 years. Yeah, if you're happy with that, then fine. And remember, 5% happens only if the valuations don't come down. If the valuations come down even a little bit, your returns might not be 5% for the next 10 years, year after year. It might be 0. And do you want to risk of getting 0 returns for the next 10 years? I am not. I don't. So these comments are just dumb. So you see the comments about dividends and earnings and valuations doesn't matter. They are very dangerous because you might be right, but then again, it might be the first time in history. And also, would you want to get 10% yield from your investment, so every 100 euros company make, you will get 10 euros? Or do you want to get 3% yield plus 2% earnings, which is 5 euros, and you are hoping that the valuations keep going up and they doesn't, for the first time in the history, they will not return to the mean? Which one is the best investment style? And then the final comment about ratios, valuations has gone up because valuations, margins has gone up. When the margins of the company goes up, the company will make more net income, which will mean that the valuations might stay the same, but because you make more net income, you make more money. But it doesn't go to that, then okay, now we evaluate this more. Okay? If you think that in the futures the margins will stay up, there will never be any competitions with companies that will put down the margins, then sure, higher margins, higher net income, maybe I can pay for the stock a little more. But again, then you are betting that there will not be competition between companies. So let's end the video by this. Would you like to get 10% yield plus the growth, which would give you anything between 10 to 15% return, or 3% yield plus growth, which is 5%, and you will hope that the valuations keeps going up, and up, and if they remain the same, you will get the 5%. If the valuations will go down even little bit, and by the way, they are highest in the history, then you might lose 50% of your portfolio, or the next 10 years you might stay the same. And when we check the CAPE ratio, for example, it's 40 currently, the cyclically adjusted earnings ratio. That's almost 40. PE ratio is what, 28, and historical is 15. And remember, it's the average. It has went under the 15 many times. It's the average. So let's say we are in the new historical highs and the bottom, and we will never go the, down, which is stupid, but let's say that. Okay, we might never go down to the 7 PE ratio anymore, but 10, 12, 15, that's still 50% down. And that's still only 3% earning yield, what you are going to get. So yeah, anyways, you pick and choose what you want to invest. Do you want to be certain millionaire, or you want to gamble and be stupid and hope that the valuations keeps going up?
And by the way, one more thing I wanted to say, actually investing in index fund, it's great. Over the long term, it's great. And you will probably make more money with investing in index funds than investing in stocks or picking stocks yourself. But don't talk that value investing is bad just because you don't understand how investing works. And especially if you think value investing is bad, then you should definitely stay in the indexes. And one tip I would say currently, even though the S&P 500 is the index that most of the people has always put their money in, currently I would be much more feel much more safe investing in world index fund and possibly some money to the growing markets. And that's because when you are investing in the S&P 500 currently, you are getting like what 3% yield plus 2% growth, so it's 5% like I said. Then if the valuations comes down even little bit, then it is 0. For the world index, it's currently about 20 PE, which is already 5% yield plus growth, 7. That's much better. And then, okay, it's probably 7% because the valuations will not probably go down as much as the United States. So S&P 500, 0 to 3%. The world index, 5 to 7%. And then the growing market index, which is PE 15 currently. What is that? 6 point something plus growth, 9%. Of course, there is always dangers in there. But yeah, so I would actually just take everything out from the S&P 500. And if you don't want to put to the growing markets, which is fair, there is risks there. The world index is much better. So anyways, if you like the video, please like, comment, subscribe for the channel. And if you have any questions for the future videos, just ask. And also there is a link below for our school group, so go to check that out also.